Hi, and welcome to this episode of the Elite Wealth Podcast. I'm Patrick Marcel, joined by Matthew Daniels and Victor Kijewski. And today we're going to start off talking about random skill. This was a tough one, but I would say random skill is weird, but I'm really good at nightcrawler picking. Going out and picking nightcrawlers. Used to do it all the time as a kid.
I thought you were going to say you had high score of bubble shooter.
No, that was a different episode.
So what skills, like, how do you get good skills on, like, you know where to go, or you got quick fingers?
No, you have to be
good eyes.
You have to have good eyes. You have to in lower light, because you can't have a full blown light. You got to have a dimmer light. You can't have red light because you can't see them. Then you got to see them, and then you got to be able to grab them without damaging them and pull them out of the ground.
It is a random skill.
It's a random. This is what we wanted, right? Random skill. I don't know. You can't just pull. You'll snap them in half. You can't squeeze them too hard. Just squish them.
Did you ever eat a nightcrawler when you were a kid?
I did.
Show off?
No, I just did because I got dared. Mm-hmm. Neighborhood.
Did you get $1 out of it or something?
No, I didn't. No. I was the youngest, and I was just peer pressure.
Triple dog dared.
Yeah, triple dog dared, pretty much. Yeah.
There you go.
So you guys are wasting time here, so that you don't have to come up with your random skill. I know his random skill.
What's your random skill, Matt? My random skill, just because we had to do it this weekend, we had a family Olympics when we were camping. Didn't know any of the events. One of them was you had to stack Oreos on your forehead and you had to walk so far. And I did it without falling. So that's my random skill. My wife was amazed beyond belief. It was funny.
It was better yet because she said, "You can't do this. Are you sure you want to do this?"
Yeah, she wanted.
And you're like, "I am going to have to prove to you I can do this."
Yeah, and I did. She was impressed.
Nice. What's your random skill?
So this is a hard one because I'm not double jointed. I can't walk backwards on a tricycle.
Walk backwards on
the only thing I can think of
is on a tricycle.
Makes sense to him. You wouldn't understand. It's in the tricycle world. The only thing I could think of is
Is that when you went to clown school?
Still has streamers on his tricycle. I would say I'm a professional apple tree planter. Really? So I know what type of soil you need, what vitamins, nutrients you need in the soil. I know when to plant them, how to plant them, how to prune them.
You're good at pruning.
The difference between the dwarf, semi-dwarf, standard, when they drop, how to optimize. Keeping bugs off of them, what spray to use. I can tell you.
I highly encourage anybody who's listening to this to put them to the test and hire them.
Come on, you saw the apple trees I planted.
I've seen the ones you trimmed, and you're a very good pruner.
I planted all of them. So, I mean, I'm pretty good at that. But I don't have any special crazy skills, to be honest with you.
All right.
That's better than nightcrawler picking. Right, Matt?
Well,
it's a random skill.
It's a random skill.
I'd say I'm pretty good at picking night crawlers myself, but
I don't think you've ever done that before.
I thought you were asking
questions like
I grew up on a farm. Of course, I picked night crawlers.
Did you eat any?
I may have taken
a bite when I was. Did you eat any potato bugs?
What's a potato bug?
Oh my gosh, you're a farmer.
Didn't you recently catch a turtle? I did. With your bare hands? I caught a 14-inch snapping turtle. It was dead already. And I was too scared to grab it, so my dad came down and grabbed it. But I guess you could say I had a skill of catching turtles.
Yeah. Dad had to come and help.
Yeah, yep. So I can catch turtles, but I think we're getting too far into the weeds into this stuff.
Okay, so anyway,
all right, host, get us back on track.
Yep, we're back on track. All right, today what we're going to talk about is the tax time bomb. Your relationship with the IRS, whether you know it or not, you have one, and what we could possibly do to maybe help avoid that. And Victor, I'm going to start off with you because you have the best, I'll call it acronym, III acronym for this.
And I can't take credit for it. I stole it from another advisor when we were at an advisor conference, but his saying he had, I think above his logo, was don't let your IRA become an IOU to the IRS. And I thought that was kind of cool because everybody has an IRA. We don't want to turn that into an IOU to the IRS, the government. So, looking at taxes, we were talking on the radio earlier today. A lot of the seminars I used to give, I always like talking about how essentially when you go into retirement or you retire, you're retiring with a business partner, and that business partner is the government.
So if you retire and all of the money you have for retirement is in a tax deferred account like a 401k, 403b, simple IRA, anything that's tax deferred really, the government gets a big chunk of that. So I don't think anybody would go into business and say, hey, I'm going to do all the work, but I need the business partner is going to take 40% of all the profits and they're not going to do anything. That's not a good deal, not a good business partner you want to retire with. So what we really focus on heavily here is tax planning. So we want to pay as little tax as possible over your lifetime. And there's different strategies we're going to talk about today on how to do that. But, if you retire with $1 million in your 401k, you don't have $1 million because, again, big chunk of that's going to the government. So how do we get rid of that tax bill in a tax efficient manner? I think we really need to be taking advantage of the current tax code because historically speaking, it's very, very low. Lowest you've ever seen in your lifetime. And it's just,
that's a long time.
That is a long time. And it's just funny too, because I always like to say we went to war over a 2% tax on tea back in the day. And now it seems like you just give 50% of all your money to the government. I really think there would be an uprising if every paycheck you got was paid out in cash and the government came into the building and you had to give the government your cut in cash. Right. So people just don't see that because everything is electronic now.
Tax collector back in the day.
The tax collector. What's the disciple's name?
Matthew,
the tax collector. Everybody hated him.
But we like this Matthew.
But yeah, it's let's just figure out how to keep as much money in your pockets and not Uncle Sam's.
Yep, sounds good. So we're going to talk about the current tax law. We're going to talk about why it's advantageous today to be making sure you're taking advantage of it. Because quite frankly, things are probably going to change down the road. So Matt, give us a rundown on the current tax law and what the changes are, or what do we enjoy right now that maybe we didn't have 5 years ago?
Yeah, so one of the big things is that was a discussion when they updated these changes last year was that the tax brackets stayed where they are. So they didn't revert back, they didn't go higher. Now, like they talk about, they are permanent now, but permanent in pencil, as we like to say. So there is no sunset date where taxes are going to revert higher, although there's a lot of people speculating, talking that at some point they're going to have to move them higher, but there is no specific date as it's set up right now. The other big thing that we talk about with a lot of our clients is if you're 65 or older, each of you as an individual is able to get up to a $6,000 bonus on your standard deduction. So if you think about, your standard deduction, married, filing, joint, you're both over 65, that's an additional $12,000 on top of your standard deduction that you didn't have before, just for being 65.
Yeah, and the one caveat to that is that as long as you're under $150,000 of income,
correct.
Once you go over married, filing, joint, once you go over 150, it starts to peel that back a bit. It does not a total loss. And sometimes Roth conversions can still be beneficial, even if you give up some of that $6,000, but you're right. And then single, that's $75,000.
And that's where we're always looking to see, okay, if you're 63, 64, can you take advantage of that additional bonus in the upcoming years, and just to put you in a better spot overall? But again, that's something that we would talk through with our clients. A couple other changes. So if you donate to a charitable organization starting this year, you can deduct up to an additional $1,000 per person per year. So $2,000 total. So if you are giving, keep track of it just because you can take advantage of that. And that's over and above your standard deduction. So it's not like you need to itemize to get to that point.
And I don't think you don't have to be 65 to do that. But the one for 65, the extra 6,000, that sunsets after 28. So 28 is the last year you can do that.
Correct.
On that one. So just a little caveat. And I guess that's why there's a sense of urgency, right? Because some of this is going to go away. And even if you go over that 150 a little bit, married, filing, joint, that still can be great value to do the Roth conversion. You're still probably going to get some.
Yeah. Oh, absolutely. I think that should be factored in because, like you said, at some point it probably won't be there. So how can we put you in a better position in these years while we have the opportunity?
Yep.
Yeah, I one last thing to add there too is that I don't think people understand how much of a benefit that is, because that will allow us to draw more money from our IRA without paying tax. It'll allow us to convert more money. It'll allow us to wash sale more in our brokerage accounts. It'll allow us to keep our income lower for Medicare so we don't pay more on IRMA. There's a lot of benefits to that. So really take advantage of that if you haven't, because I would say most people don't even know that exists and they just do their taxes the same exact way.
Well, I think everybody got an eye-opening this last year when you got your tax return.
I would say.
I know that, with Katie being on board and us doing taxes the first year last year and now doing tax preparation again this year, I just saw people like, I can't believe how much money I got back.
Yeah, a lot.
Because the 6,000 was a huge help. And then another question I get too on just to finish up maybe the conversation on the current tax law, on that $1,000 charitable giving, some people say, do I need to have receipts? Just track it. You just need to basically have the charity name and the address. That's really all you need.
I thought you don't need anything. You give
well,
cash.
If you get audited,
I was gonna
if
say,
you get audited, you want to have a way that you can prove that you gave it.
right.
So you do want to be careful. You don't have to file it with your taxes.
So there's a question, because I give cash to my church that's going to count.
Yeah, but don't you get?
So typically with the church, they'll give you envelopes so you can put the cash in the envelope, and then
I just do cash though.
Then they won't track it.
Then they don't
so
track
I could get in trouble for that, huh?
Yeah,
because you won't. Yeah, if you put it in the envelope, then at the end of the year they give you a form saying you've donated this much for the year.
I would guess there's probably a certain amount you could probably still write off discretionarily, but we'd have to ask Katie for that answer specifically. I mean, if you just take your envelope, you throw it in there, then they give you your statement at the end of the year to put with your taxes, then that's already done for you. But I think it's great. A lot of people have their favorite charities that they like to donate to, whether it's ASPC or, Children's, or this quarter, we're doing St. Jude's. If you give to St. Jude's, so we're doing a little awareness on St. Jude's. If you come into the office in Plover or Corona, you'll see a St. Jude's chart, and there's little pins, and go ahead and take one. We just want to raise awareness. It's an amazing organization for the kids that really need help. So that's really the current tax law, why we're looking at it. Tax brackets are low. They've indexed up a little bit because of inflation, some other things. But really, it's huge how much money you can move over out of a pre-tax situation into post-tax. There are some caveats. We'll just say that. We're not going to get too far down the road into the different caveats and why maybe you shouldn't convert. But why do we need to do this? I always look at it this way. The way I explain it is that, if you could have a decision to pay taxes at a rate today versus a tax rate that is unknown in the future, what would you prefer?
I'd rather know the rate instead of projecting, because if you're wrong, you could be really wrong.
Yeah. We're at historically low levels for taxes. We have that silent partner, the IRS. Uncle Sam wants their cut, wants his share. They also changed the rule back in 2022. They changed the inheritance rule. So now when you inherit an IRA, or Roth IRA, or regular IRA, you have to take it out over 10 years. And if you haven't been taking, and they have been real strict on this, but if you haven't been taking some out each year, you probably really want to start doing that, because it sounds like they're going to really start to focus on that, because you're supposed to take out 10% of the account value plus any earnings from the previous year as your distribution. You're supposed to do that every year. So just be aware that they're probably going to start looking at that if you've inherited an IRA or Roth. But those are reasons why, again, you got to really pay attention to what's going on. You have to be aware of it. IRS wants their money. I think that it's very likely that we'll see taxes go higher somewhere in the future. Just look at the national debt. I think that tells the biggest story right there. And I think right now, too, the Federal Reserve Chair at this point wants to reduce the balance sheet. And so that could cause a bunch of different scenarios, and that can actually feed back into taxes on that end, too. So I think there's definitely a lot out there. All right, so we're talking about the current tax law. We're talking about this stuff. We alluded to the Roth conversion a little bit. So when we sit down with somebody, Matt, that wants to do a Roth conversion, what kind of things do we need to know?
So I think we always start off by explaining to clients that not everybody should do a Roth conversion. So to understand if it really makes sense for you, what we want to figure out is your full plan, right? So how are you getting your income? How old you are, what do your assets look like, and then how much are you spending, kind of the basics of our planning situation. From there, we try to determine, all right, what tax bracket are you in now, and what tax bracket will you be in? So what we're trying to avoid is that tax time bomb, right? So
what is the tax time bomb? Explain that so everybody knows what we mean by that.
Yep, good. So the tax time bomb is, some people don't realize they might be in the 10% or the low end of the 12% tax bracket, but they're not spending down enough of their traditional IRA accounts. So they're going to have this huge required minimum distribution, or RMD, when they turn age 73 or 75. And again, we can tell you specifically in your situation what that would look like, but they might jump from the low end of the 12% tax bracket up into the 22% tax bracket just in 1 year if they don't plan accordingly. So what we're trying to do is, again, saying, all right, 10, 15 years from now, this is what the picture looks like. Do we like that, or do we not like that? And can we do anything to put you in a better position long term? Can we even out that tax burden and over the course of time save you thousands, if not hundreds of thousands of dollars, just by doing a little bit of planning and having a conversation?
So, Victor, I want you to share our process. So now we have the information that we need, usually the last 2 years of taxes, all their accounts and where they're at, so we can project minimum distribution, all that stuff. Okay, now how do we do that? Like, what tools do we use to help our clients understand what lies ahead of them if they do nothing?
So yeah, it's because if we go through the process and we just tell someone you should do a $20,000 Roth conversion this year, they don't know how that's going to save them money down, how much money it's going to save them, if it's going to save them money, if they're doing the right thing, right? So we have to be able to show you something that says, okay, if you do this, this is going to happen, right? So we have a couple tools at our disposal to actually show clients how much money it'll save them and the benefit down the road. The first one being Income Lab. So within our planning software, Income Lab, we have a tax lab. And the tax lab is basically going to show us all of our distribution strategies, Roth converting up to the top of the 37% bracket, all the way up to the IRMA brackets, and basically kind of help us figure out through their system what the best distribution strategy or conversion strategy is going to be for you. And it's really cool because it shows you, how much money it would save you in taxes over your lifetime. It shows you when you're going to break even on the conversions. It's going to show you a bunch of cool stuff.
What's the assumption, though, that we think people should be aware of on that about taxes in the future on that?
Well, the cool thing is with the software, it's showing you how much money you're going to save over your lifetime, but it's assuming the tax rates stay the same forever, which they're not going to. So I will say one way a Roth conversion could possibly hurt you is if you convert and then taxes drop, tax rates drop. How likely is that? I've never seen anybody I've ever talked to say taxes are going to drop in the future. So we are banking on a higher tax code in the future. But even if taxes stay the same, it's still going to show you how much money it could save you. But I really think if you're not at least looking into Roth conversions every year, you're really just throwing money out the window because I'm trying to work on my analogies. Patrick says I don't have good analogies. But not
I didn't know
right
that I
under
said
the bus. You guys always say that to me. Tell me if this is a good one, but I don't know. Not looking at your taxes each year is kind of like, I don't know, taking out a 30-year mortgage at 15% and paying the minimum payment every single year. That's really bad debt with a bad interest rate, right? Yeah. So if you don't do any tax planning, you're just basically saying, okay, I'm just going to pay this tax rate. I don't care what taxes are going to be in the future, and I don't care if I waste my money. So it's really important to sit down and figure out if a Roth conversion would make sense for you. And for a lot of people, it does. For some people, it doesn't. But I would say if your income's under about $130,000, you're married filing jointly, there's probably something we can do there.
Yeah, and I just want to add one thing to that, because a lot of people don't realize, they'll either have analysis paralysis, or they're like, well, I've never done it, I'm not used to it, and new is always scary, right? Or not always, but a lot of times for some people it is. And they won't do anything, and then they'll get to their required minimum distribution age, and they'll go, holy smokes, Matt, you were correct. Can I do anything now? Because I don't like the taxes. Well, unfortunately, once you get to that point, there's not always a lot of great options that you can do. So again, planning in advance can put you in a much better position.
Maybe a better analogy would be is like having a 30-year mortgage with a 10-year balloon, or an adjustable rate mortgage. So maybe you can only afford the mortgage at the discounted rate on a 30-year term, but it balloons at the end of 10, and then you're subject to whatever the interest rate is in the future, and refinancing of that. A lot of times if you buy recreational property, it'll do that. It'll be on a 30-year amortization schedule, but it'll balloon after the 10th year or 5th year.
And then you'll say, I don't like that rate.
Right. And then they say, too bad. If you don't like it, sell the land, property, or whatever you have. And I think that's really, I think is a good analogy, because it's exactly what it is. You're financing what you owe the government. And what we're trying to do is, we're not saying don't pay taxes at all. We're just saying, let's pay taxes at the lowest rate possible, so that we can put you in a position to succeed and to keep as much of your money that you work so hard for in your pocket.
And that comes back to retiring with that business partner. Because again, when you retire and they, your business starts out and they say, I want 20% of everything and I'm not going to do any work. Say, okay, have to sign me up for that. 10 years down the road, they still haven't done any work for you. And they say, well, you know what? I want 40% now. And there's nothing you can do about it unless you have a tax efficient plan.
Right. So I'm going to just move on to another tool that we have, Matt, and I think it's to help us as advisors and Katie to really get to the bottom of like, how much can we do per year? So do you want to delve into the tax what if and how that works?
Yeah, absolutely. So right now with a lot of clients in the summer, we're doing tax planning. We'll bring them in, and if it makes sense, we'll have Katie sit in just to talk through it, and we'll get the last couple of years of tax returns, and we'll put it into what we call our tax what if software. Now, for some people, it's a very colorful spreadsheet that you see, but it's really nice because we can sit there, we can put in your taxes from 2025, and then we can enter in what we think we could do from a conversion standpoint, and it'll tell us, are we going to remain in the current tax bracket that we're in? Are we going to be under the Medicare IRMA limits? It's going to tell us a lot of great information, but I think it helps people visualize, especially if they haven't done it before, exactly where they're going to be. And then we can have a conversation around it in terms of, healthcare premiums, IRMA limits, staying within current brackets. And it's just another tool at the end of the day to make sure that our projections are as correct as possible. Nobody likes surprises. And what we don't want is for you to go to your accountant in April and say, what the heck did you do? Did you think about this, that, or the other thing? So again, it's just having a conversation up front so we can get out ahead of that and make sure that you're in the right position.
All right. For quiz for lunch. I'll buy somebody lunch if you know this. No cheating on your computer.
Is it a computer out here,
No,
folks?
No. What does IRMA stand for?
Income related monthly
Medicare adjustment or
income related.
You got to say the whole thing.
Income related
Medicare adjustment.
Wait. Hold on. Don't give us the answer yet.
I just
income related monthly adjustment.
No.
Amount.
No, he's right.
What was it?
Income related
Medicare adjustment.
Same thing.
So you had it almost, but you didn't put it all together. And then he heard what you said, and then
for
he
lunch
put it
at Texas Roadhouse.
Texas Roadhouse. Maybe. They have lunch.
Sure.
They don't have lunch. But anyways, so it is one of those things that if you have too much income, you can actually pay more on your Medicare Part B premium and Part D. And that's what we want to try to avoid too. So there's all these things that we have to pay attention to, and that tax what if software is really great to help us make sure we're not running into those problems. Mm-hmm. Because if you have a year where you have income too high, the next two you'll be penalized.
Yeah.
I think that's really the best way to look at it. Is just it's a penalized feature of that law. Is you made too much, now you're going to get hit with that. And it's actually, I think it's kind of archaic, quite frankly.
What do you mean?
It's just, when they first came around and they first had the IRMA, income was much lower. It hasn't really gone up a ton. Yeah. It feels, I think more and more people, it's not uncommon to see somebody with up to $200,000 of income a year when they retire. And that's just, so the law doesn't really reflect, I think, what it costs to be retired and have a good lifestyle. And then I know we were talking on radio earlier today about, what your number is and how that's kind of a fallacy a little bit, right? But what it takes to get to retirement and how much you need to have and having a plan. But overall, again, this is all part of the whole planning process that, where I think as a firm have really done a lot of work, putting together a lot of tools and helping people have an understanding of their retirement, what the numbers mean, how it all works, what does it look like in their retirement, what do they use when? It answers all these questions. Mm-hmm. And I think that, the other part with us surrounding ourselves with great people, great professionals that help us make sure we have the best answers possible. And that's why we brought Katie on board. Mm-hmm. And I think you all both have worked with Katie before now and with clients. Mm-hmm. What's the value, Victor, of having Katie sit in or have us being able to do taxes for our clients?
What's the word I'm looking for? It's I'd say it's basically priceless because, if you don't have a good financial planner, accountant, and attorney in your corner, it's really hard to win it in retirement. We talk about how retirement is so much more complicated than it used to be. And I think the government just started creating all these laws and rules. So you miss a step and then you owe the government an extra $2,000. So, if you can have a financial advisor set up your retirement plan and then kind of pull in an accountant that's on the same page, I think that's a really important part too, because a lot of accountants will you give them all your statements, they do your taxes. They don't kind of incorporate what type of tax plan or look ahead to the future. They're just concerned with that year's tax return, getting you a big refund. And that's what you can't be doing. You need to figure out a long-term strategy. And I think that's what she's really great at, is kind of getting on board with our theory and doing more of the tax planning instead of just the tax preparation. So I don't know, that could save you $500. That could save you hundreds of thousands of dollars. It just depends.
Yeah, would you say that it would be a fair, maybe it was something I heard when I was played football in junior high and high school.
Elementary.
I didn't play elementary. I did play flag football flag football in elementary school. But that when you're a backup, you make the starter better, right? So all these different pieces. So when you were in, I'm not as familiar with your high school. I know that you did really well. You were a really great quarterback in high school. You both were. But would you say that it's fair to say at that competition level, one athlete or just one good professional can make all the difference?
No.
Versus at college where it's a complement of multiple really good players?
Absolutely. I mean, I know, especially when you look at the NFL, it's a big deal to get the right backup quarterback in a room with your starting quarterback. For example, you'll see a lot of times they'll take a younger starting quarterback and they'll get an old seasoned vet so that the younger individual can see how they prepare and they're able to point things out. I mean, you can take, being from Wisconsin, Brett Favre always wanted Doug Peterson there. Well, there's a reason. I don't know if Brett was the greatest at reading the defenses all the time, but he was paired well with an individual that I'm guessing, not being in the room, could speak to him in a way that he understood it and was intelligent about the coverages. Example would be some of that. So I think it's the same thing from a tax standpoint. You know, Katie does a really good job of thinking about the future, right? And wanting to know about your tax plan overall, not just your return this year. And I think that's an extremely valuable thing, just because, you know, it's thinking about putting yourself in the correct position down the road, not just your tax return this year.
And we're kind of the backups, if you will, except for not the season vet, but Katie's really the star that, you know, when it comes to taxes and helps us be better, helps us prepare better. So she's maybe that more of a seasoned vet as well. And I think that's, you know, part of the vision of what we're planning on doing or what we're trying to do here at Elite Retirement is that we want to be able to have a one-stop shop for folks. We want people to be able to come in and get everything they need taken care of so that they don't have to go all these different places and everybody's working on the same page. I still hear time to time people are like, I have my retirement spread out between these 3 advisors. And it's like, well, why? And as you know, I used to hear, well, you know, all your eggs in one basket, and it's like, well, yeah, the handle breaks, yada yada. But this isn't Easter, so it isn't about that anymore. It's just that if you go and you hide your eggs all over the place, you can't find them all, and some are going to go bad, and that's what ends up happening. Is you have all these advisors doing different things, and nobody knows what the other one's doing, and stuff's going to get missed. So I think that's just something, again, that's why we try to build out what we're building out here at Elite Retirement Group through bringing professionals into play. So you guys want to add anything? Otherwise, I think it's a wrap for this episode.
Yeah, no, I think the biggest thing is just to sit down every year and create a tax strategy, because if you don't have one, again, you're just throwing money out the window and you don't even realize it. So, you know, are you taking advantage of the current tax code before it expires? Are you taking advantage of the extra $6,000? Are you taking advantage of writing down that money you give to? There's just so much, you know, things to get into that you kind of have to sit down with a professional, figure out all the minor details, and then create a plan going forward. So, you know, we could talk for days about taxes. I really like talking about taxes because, you know, not only does the government take a lot of your money, whether they spend that efficiently or not, you know, on top of that, they print money every year. So the value of your dollars you get to keep that the government doesn't take from you goes down every year. So it's just so important to create an efficient retirement strategy.
How about you, Matt?
Yeah, I would say now is the time, really the best time to sit down, because you don't have the crunch of the year end to worry about it, right? So let's sit down, talk about it. If we need to have more discussions, we have time to do that. So then when year end comes and maybe you're a hunter or maybe you're getting ready for Christmas, you don't have to worry about it because we've done kind of the core of our planning.
Or if you're getting ready for the Blue and Tower Defense playoffs.
Yeah, that could be as well. I don't know. When do those happen every year?
About half the time.
Are those in December?
I don't know what you're talking about.
Well, we don't play. We don't ask us.
You guys both sound like you know way more about this than I do.
I don't know.
Anyways, well, thanks for joining us this week. And if you have questions, you want to learn more about something that you heard on today's episode, you can give us a call at 715-341-8899 or visit us on the web at eliteretirementgroup.com.